The bear flag mirrors the bull flag entirely, just applied to downtrends, and it's a favorite pattern among traders looking to study how downtrends pause before continuing. It forms in two stages. First, the flagpole, a sharp, steep decline on heavy volume, reflecting aggressive, motivated selling. Second, the flag itself, a brief pullback or drift upward, usually sloping against the prior trend, contained within two roughly parallel trend lines. The tight, angled channel against the trend is what gives both flag patterns their name. Volume is the key filter for separating a genuine bear flag from an actual trend reversal. The flagpole should show strong, heavy volume on the way down. The flag portion, the bounce, should ideally happen on lighter, contracting volume, since it's generally interpreted as short covering or mild profit-taking by early sellers rather than a genuine shift toward buyers taking control. A bounce that happens on strong, expanding volume is a caution sign, since it may indicate real accumulation rather than a temporary pause. Confirmation comes when price breaks back below the lower trend line of the flag, ideally with volume picking up again on the breakdown. This is typically viewed as the downtrend resuming. A measured move target is often estimated by taking the length of the flagpole and projecting that same distance downward from the breakdown point. Though, as with any measured move, it's a planning tool rather than a promise. Timing matters here, just as it does with bull flags. A genuine bear flag is usually brief, often just a handful of days on a daily chart. If the upward drift extends much longer, it starts to look more like a broader consolidation or even a potential bottoming pattern rather than a tight continuation flag, and traders need to reassess which structure they're actually looking at. For risk management, a stop loss is typically placed above the high of the flag, since a break above that level would suggest the bounce has turned into something more significant than a pause, potentially an actual reversal. Traders also watch the steepness of the flagpole decline. An extremely sharp, panic-driven drop followed by a flag can sometimes reflect capitulation and exhaustion rather than healthy continuation, so broader context still matters. The main failure mode is mistaking a genuine trend reversal for a temporary flag, especially when the bounce comes with unexpectedly strong volume. Studying the bear flag alongside its bullish counterpart makes both easier to recognize, since the underlying logic, volume behavior, and risk framework mirror each other closely across uptrends and downtrends. This video is for educational purposes only. It does not constitute financial advice, and trading involves substantial risk of loss. Always do your own research and consider your own risk tolerance before making any trading decisions.